Markets near all-time highs. Our guest says falling interest rates are a positive sign, but he says beware of overvalued companies. He is bullish on real estate, and he has two stock ideas to share. We're joined by Tim Regan, Managing Director and Portfolio Manager at Kingwest Company. It's great to see you.
Great to see you, Andrew.
Can we talk just briefly about Dental Corp, DNTL? You probably know there were a roll-up story in the dental industry being taken private. Maybe you could put up a 5-year chart.
Okay.
I think they've been around for 5 years, maybe a 3-year chart. Anyway, the reason I'm bringing it up is it's yet another sign of lack of support for smaller companies on the TSX.
Yes, I mean, we had looked at this a while ago, did some research, decided not to buy it. Some of it was the illiquidity. And I think what you're going to see is this is really looking at private equity who are flush with cash. What do they do with it? Mm-hmm. So if I'm a smaller, undervalued company, private equity could be my best friend.
Yeah, if you're a shareholder, you mean in one of these companies, yeah. I see Bruce Flatt of Brookfield says there are far too many private equity firms. Apparently there are 7,000 private equity firms in the States, and Flatt is saying, well, a lot of those are going to have to wither away.
Wouldn't disagree with him at all. We are shareholders of Brookfield, and we own a few other bigger private equity companies like Blackstone and KKR. And it looks like in the private equity space, the big ones will really dominate. They have the scale, and they have the scale to persevere through tough times.
Yeah, it's interesting. I wonder why so many private equity firms were started up.
A lot of money in it. So a lot of money and a lot of money going into private equity these days.
Isn't that interesting? People just disenchanted with the stock market?
Well, they're in search of higher returns. Higher returns and less volatility. But
yeah. Anyway, at Brookfield, Bruce Flatt says there should be thousands fewer private equity firms.
Not disagreeing at all.
Yeah. I mean, I guess it's reasonably easy to start one up if you can get a bit of capital. And
well, it is getting the capital. And having the skill set. And so a lot of them will be rolled up under different banners or just wither away. We'll see what happens in the next 5 to 10 years.
You have a chart for us. It's a little complex. So you're looking at the total return on stocks in the Russell 1000, or the valuation, I'm sorry, in the Russell 1000, the growth stocks versus the value stocks. And of course, the Russell 1000 is 1,000 big companies in America.
Correct. So this is just growth and value, or we would say companies that maybe the valuation is a little stretched, and it tends to be tech companies versus cheaper companies. It's very simplistic, but it just shows that right now there's a disparity between the two that we haven't seen since the tech bubble. Is this the AI bubble? I don't know. But history, as Mark Twain said, may not repeat itself, but it does rhyme. So just beware the higher priced companies. Right.
What about real estate? You have some ideas for us, but broadly, lower interest rates good for real estate.
Lower interest rate is good, and real estate's been terrible. The real estate, REIT stocks, even real estate stocks for the last number of years. We have a few holdings in real estate, and one of them I think that we sent here to focus on, we've talked about forever, is Smart Centers. Smart Centers is fabulous. If you look at the chart, it's yielding a little over 7% right now. It's not a great chart. It looks to be treading water a bit. But Smart Centers we first bought in 2020 in March, and it went on sale at about $16, $17. It ran up quite a bit and then fell back down. We think Smart Centers today just is very easily worth $35 today just on their base business. But they also have a lot of real estate that they can develop into condos. Condos, we know in the GTA are a bad word these days. To say the condo market's soft might be a bit of an understatement. But all they have to do is really zone for it. They don't have to build above all the stores, and it's ready to go in 3, 4, 5 years when the condo market cycle gets back. And that's not at all valued into the stock at all. And so Smart Centers, great management, and they're doing a great long-term job.
And the yield of about 7%.
Yes.
Here's a new name for us. Amrise trades in the New York Stock Exchange, and it's newly formed, but it specializes in construction materials.
Yes, it's an aggregate company. Most people, the core of Amrise really is the old Lafarge. Everybody knows Lafarge. So they're huge in North America. What happened was Lafarge was bought up, and it was Holcim out of Switzerland. And Amrise is really their North American spin-off. So they spin it off. It's about a $28 billion company. They're one of the biggest aggregate concrete makers in North America. They do roofing as well. The Swiss CEO actually stepped over to North America, put in his own money, and is running Amrise now. And so if you want to buy into an old company that's established, that's back on the market again, and we know all about infrastructure. I think a lot of your guests talk about it.
Yeah.
Great infrastructure play.
The vast amounts of concrete will have to be poured for this stuff. Yeah, I'm looking at a market. Wow, big enough company, north of $26 billion US. Yeah.
Yes, north of 26, and and as I say, you know, the core of it, I guess, in North America is the old Lafarge North America that used to be publicly traded. We all know, or drive by some of their quarries. So this is not a new business at all.
I'm guessing a company like that, it's going to grow in line with GDP a bit faster?
Well, it will, but you know, what is the price today? It's been soft since the IPO, and also was a spin-off, so a lot of the Swiss shareholders don't really want to own a North American aggregates business. They want to own the European company as well. So, you know, this is a long-term play. They also have a long runway to do M&A deals and buy small quarries, concrete makers, roofing makers. So we think this is a great long-term play and a good entry point for it. So new to our portfolio, but it's new to the market since the end of June.
Yes. Yeah, we always like to hear about that, fresh ideas. How are you playing the so-called hyperscalers, the giant internet stocks? Are you attracted to Alphabet or Meta these days?
We have a position in Alphabet and Meta. It's not outsized. It's not even as much, I think, as the S&P 500 right now. Those are the only two tech players we have, and we've had them for about 5 years now. You know, looking at things like NVIDIA and some of the AI stocks, they just seem to be extremely valued. Whereas Alphabet, Meta are trading at reasonable valuations, but you know, you see the chart there, they've gone up quite a bit, but their cash flow is growing with it. So if I can say that, you know, Alphabet and Meta are reasonably inexpensive in the low mid 20 multiple and growing, you know, that's pretty reasonable for this market right now.
Is either gold or uranium catching your eye these days?
No, but that's more based on us. We tend to avoid gold because we can't predict where it's going.
No one can, I don't think.
I think I was on here one show where we showed the price of Barrick versus the price of gold over 30 years. And I don't think Barrick had positive returns for 30 years until the last 3 months. So they're not great investments over time. And we tend not to chase things. If you see us buying stuff, it's the stuff you don't know, like Amrise, or the stuff that has negative press. So that's just what we do.
Yeah. And what about uranium? Does that interest you at all? Or?
Yeah, I think we missed the boat on Cameco a while ago. But once again, it's a commodity, and it's a commodity that will move quite a bit more based on world factors and what governments are thinking, and who can predict what governments will do or they think.
Yeah.
That's a mug's game.
Yeah, and we know that these, despite all the hype, these nuclear projects will have massive cost overruns and years of delay on past form anyway.
Right. So I mean, it's not that we like it or don't like it, we just avoid it because we don't know what's going to happen with it.
Tim, thank you very much indeed.
You're very welcome. Great to see you.
Tim Regan, Managing Director and Portfolio Manager at Kingwest Company.